G'day everyone and welcome to the Digital Investor Podcast. I'm your host, Matt Rard. Now today we're going to be looking at the bigger game when it comes to website sales in the tens of millions of dollars and what it takes to grow and sell these multi-million-dollar website or online businesses. So my guest today, Isaac Porter, specializes in selling online businesses up to $300 million. Yes, you heard it right, up to $300 million. Isaac's been in M&A for the last 20 years. He's analyzed thousands of deals. And not only that, he has a network of over 1 million buyers, including family offices, high net worths, private equity firms. So Isaac has a lot of experience, needless to say, looking at these big multi-million dollar businesses. So Isaac, thank you so much for coming on today.
Yeah, Matt, thanks for having me. It's good to talk with you again.
Yeah, so Isaac, you should mention, who do you work with to facilitate those deals?
So I work with website closers. I'm a website closers broker and franchisee, and all of my transactions are represented through the website closers platform. My average transaction size, excluding two really big deals that I've listed this year, has been about $8 million.
About $8 million, and
yeah, which we consider to be lower middle market here. So kind of at the the large end of small business or the small end of big business.
Awesome. And then also you're the host of the Website Closers podcast, the Deal Closer podcast.
Yeah, I am. Yeah, we've been doing that for going on 3 years.
So Isaac, what we want to look at today is based on your extensive experience, 20 years experience analyzing thousands of businesses, and particularly looking at these multi-million-dollar websites, we want to see some insights into what they like to grow and what do they like to also sell and structure those deals from what you're seeing, because you do lots of these bigger deals. Typically, over the last few years, what have you seen in the marketplace? Like, what are the sweet spots that you're working in where there's the most activity?
So we've seen a lot of good transaction flow and strong multiples in the digital agency space. We've represented a number of digital marketing, performance marketing, SEO, backlink building. We've done some content sites like we talked about, but online service-based businesses that have some form of recurring revenue are very desirable right now. We've certainly seen a lot of e-commerce brands, in particular in 2021 and 2022. We were getting really strong valuations in e-commerce brands. We still continue to represent a number of larger brands. We've seen the multiples come down about 40 basis points over the last 12 months, but still we're getting deals done with good valuations. The deal structures have changed a little bit. Those are kind of like two of our big key focus areas from an industry perspective.
Awesome. So Isaac, this is going to be music to the ears of a lot of our listeners here, because we teach a lot of our members are very successful at running digital agencies, particularly here in Australia. And I keep saying to everyone, look, this trend is coming to Australia that we're seeing in America, where digital agencies are suddenly, the valuations are going, well, they're very attractive. So what's the typical size digital agency that you're helping to facilitate the sale of over there in America?
We've represented agencies of all sizes. What I'm working on myself and with my business partner are agencies that are in the $5 to $20 million range. Awesome. And I think part of what we've seen, Matt, driving valuations is strategic buyers who are either funded private equity groups that have an existing platform investment of some type of digital agency, and they're bolting onto that, or other large agencies that are just looking to acquire customers. And I think what's driving some of the thesis for those investors is there's a lot of new technology out there that can create efficiencies within agencies. So they're looking at ways that they can acquire agencies, keep the human capital talent, but cut out some of the operational overhead. And then they're looking at cross-service, cross-sells of if I'm a SEO agency and I buy a backlink agency, I can sell to both sides of the customers, or I can sell, social media marketing services to SEO clients as well, things like that.
So let's have a look first at the sellers of these, say, digital agencies. How long would those businesses have been around in the 5 to 10 mil range?
Yeah, we're seeing a lot that are 5 to 10 years old. That's been a pretty common theme in the digital agency space. What the buyers are looking for is the book of business and the team. And so those companies that have had a little bit more of a track record tend to have a stable book of business and a pretty well developed team.
And are these, like, when you do that analysis on them, are they digital agencies that were started out building websites for small local businesses, or are they specialized in certain niches, or is it like, what's their typical business model?
That's interesting. I think that a lot of these companies did start with some kind of web dev. I think the reason that they've gone away from website development is that tends to be kind of non-recurring work. It's pretty low margin, but it is a good funnel to get customers into a business.
What sort of EBITs are they doing? So anyone listening, EBIT is earnings before interest and tax. So basically profits. What sort of profits are these multi-million-dollar digital agencies typically doing per annum?
I think the sweet spot for us, and again, there are agencies out there across the entire gamut of, from not profitable to tens of millions of dollars of profit. But I think where we've seen really good buyer interest is in the $1 to $5 million of EBIT space. That tends to bring in
1 to 5 mil profits. Mm-hmm. And at that level, Isaac, what's the typical staffing that you've seen for those sorts of digital agencies?
That's also changing right now dramatically, because a lot of the buyers are looking at ways to reduce, non-customer facing staff or outsource. We're seeing a lot of talent, like in creatives and media buying, being outsourced and automated. So, but just in general, those agencies have 20 to 50 employees. They're geographically dispersed. At least some portion of that staff is going to be located in, in the Philippines or in India, Pakistan. And then often, at least in the US, what we're seeing is the client relationship managers, or the people who are directly talking and part of the sales staff, are based in the US. They typically don't have a physical office at this point. Most of them have gone to a full work from home model, which is also makes it easier to attract talent, because you can hire them anywhere. Okay.
So they're pretty, like, compared to bricks and mortar businesses, they're a pretty nimble setup, really.
Absolutely. Yeah. Yeah. And I did bricks and mortar M&A for a big part of my career. And I think that's a common theme across, what I call digitally native businesses, right? Is they're relatively lower overhead, higher margin, just kind of a flatter org structure in general.
And so turning to the buyers, then that's obviously why they're attracted to them. Are these digital agencies, are they easy to sell as an M&A expert, like at that level, in the multi-million-dollar range?
Mm-hmm. Is that an easy sale? They're easy to find buyers for. We have really strong responses, and we'll have, in an agency with, $2 to $5 million of EBIT, we're going to get a lot of offers on those deals. Closing any deal, any transaction is always a significant amount of work. So I wouldn't necessarily say that part is easy, but getting through due diligence and getting to the closing table takes effort, but we have a very high closing rate. So I would say that our success rate on closing listings that we represent is over 80%.
So presumably, as you mentioned, you've got lots of buyers there. That's pretty easy to get a lot of interest in a digital agency or an online business with an EBIT of $1 million plus, $1 million to $5 million.
Yeah, that's most sellers anticipate that the hardest thing to do will be finding a buyer, and that, in fact, is not the case for us. Finding the buyer is generally the easy part. Finding multiple buyers is relatively easy, and we've got a process to do that, and we've got to, we cast a broad net, and we do a lot of strategic outreach, so we know how to get the buyers. I think where most of our work comes in, and I think the value that we add through the process as brokers is in negotiating the terms of the deal to get to agreement. So we're looking often at multiple offers and using those offers to negotiate back and forth with sellers and buyers and try to get to a deal that makes sense for both sides. And then getting through closing. So once you go under contract, you've got a signed LOI, everybody's agreed to the high level business terms. You go through the due diligence process, financial due diligence, legal due diligence, tax due diligence. A lot of the companies we have that we represent, have operations in more than one country. So we have attorneys that are licensed in multiple geographies involved. And so that's where a lot of the work comes in of getting those deals across the finish line. And that's where we spend most of the time.
And so say on that 150 million business, that's an online marketplace. Is that easy to find potential buyers for something like that? What's happening at that space?
So there are fewer buyers for that particular deal because it's got some uniqueness to it. I think when we look at larger deals, we don't you don't need 100 buyers to sell a $150 million company, right? You need 5 or 6 buyers. It's very helpful to have more than one. You really only need one buyer, but two. It's very helpful. Yeah, it's very helpful in a transaction, as you know from your experience, Matt, to have at least 2 buyers. Then you've got a process. When you're dealing direct with only one other buyer, neither side has very much leverage, and it can be hard to get to negotiation. It can be hard for sellers to kind of get a good read on the market and know if they're getting fair valuation.
And the typical buyers at that 100 mil plus range,
they're almost all private equity groups or family offices. So these are institutional buyers. They're professional buyers. They've acquired generally other businesses with a similar business structure. So they're experienced buyers in this space that are funded with capital from, either private capital, or sometimes they've got bank debt. Vast majority of them have private capital.
For someone listening to this, wanting to get into, say, a $4 million website business, can we look at how some of the numbers might work? Because in America, there's more access to capital for these businesses as well. So can we look at, like do you have an example we could talk about how the numbers would work for a $4 million business acquisition?
Yeah, and I can give you an example that we published recently as kind of a white paper on a deal structure for an e-commerce site that we sold. This was an e-commerce brand. About 30% of their traffic's coming from paid media. We listed the business for right around $4 million, or actually listed for a little bit over $4 million. I think the closing transaction was in that range. $800,000 of earnings, so EBIT, $800,000 of EBIT in the trailing 12 months periods. The last year the company had made about $800,000, and the business was growing at a 30% growth rate.
Nice.
One of the things, like you mentioned, Matt, is that we do have access to, for USA-based businesses and USA-based buyers, we have access to the Small Business Loan Administration Program, and the program we use is called the 7A loan program, and it's basically you can get loans for financing businesses. You can get financing up to 90%, in fact, to acquire a business and a 10-year payback. So that's really compelling. We sell businesses all over the world, and the SBA loan program doesn't apply to those businesses, and there's plenty of ways to get those deals done too. We have private investors, and there's we can structure deals with some portion of seller financing and things like that. But in this particular deal, the buyer put down $400,000, and the seller held a $600,000 promissory note. And the bank provided a $3 million loan. So that comes up with your $4 million purchase price.
Okay.
And the interesting thing was that the company was throwing off $800,000 in profit. So after the loan payments were about $400,000 a year. And after the loan payments, there's $400,000 of net, free cash flow. left over. So the buyer returned her cash on cash investment. She put in 400,000. She returned 400,000 to herself in the first 12 months. So it was 100% cash on cash return in 12 months. And then we took, in this example that we published, we looked at, what if that business continues to grow at the 30% rate, which it had for the last 2 years, what that would look like in 5 years. And it's a pretty compelling investment thesis, even if it's, even if you didn't get all the way to that growth rate, but at a 30% compounded annual growth rate, that company would grow to about $2.5 million in earnings in less than 5 years and have a valuation of about $12.5 million. So for an initial investment, plus the buyer then would have been making cash flow of over, net over $400,000 a year, plus then the growth, for that 4-year period following when she returned her initial investment, and had in excess of a 20x return in 5 years.
Yep, and that's how you do it, 20x return. And the buyer, who was she? Like, you see your typical buyer down at that, $4 to $5 mil range.
Yeah, the buyer was a professional who was looking to get out of a corporate America. Had accumulated some savings and leveraged it with a loan and bought herself a business to operate. The seller helped her transition the business and with training for a transitional period, and that's a good success story.
And had she, out of interest, Isaac, had she ever had much experience running an e-com business or anything, or did the seller basically teach her the ropes?
She did have experience in the space. She knew about paid traffic, and she was technically somewhat sophisticated. It wasn't a complete newbie. We certainly have sold businesses to people without a lot of experience. I think one of the things I always advise the buyers is, if you don't have experience, you need a good mentor. You need some training and a coach, to help you kind of get ramped up. And most people will start off with a relatively smaller deal and build up. In this case, she had owned some other websites that had given her confidence and some skill set. And this was her first real purchase, but it wasn't a complete,
That is, Isaac, that's the perfect journey that we love to teach here is, and thank you for sharing that story, that you start out, if you're listening to this, start out small, like Isaac said, get some experience, and then you can step into these bigger businesses. And if you're lucky enough to be in America, it is a lot easier to get financing to buy websites. Now, that's an interesting space because we don't have that here. How much can you borrow on these SBA loans?
The SBA loan program goes up to $5 million. So you can borrow $5 million, which, means you could foreseeably get into a transaction of $6, $7, $8 million if you had some capital to put down and the seller held a note. An EBIT perspective, companies generating $2 to $5 million in EBIT are great businesses for us to sell. From a transaction size, $4 to $20 million is really the space that we're doing a lot of volume in. $4 to $20 million of enterprise value. And so that's just what I see is there are a few inflection points, and we started talking about this previously as well. But in that under $1 million of earning space, so the example we just talked about is a company making $800,000 a year. Those businesses are often being acquired by individuals who maybe have a couple other businesses in the space, but they're buying those with SBA loans, and they're buying them to operate themselves or add their team into. Once you get over $1 million in earnings, we're seeing quite a lot of buyers who are the institutional buyers that I was talking about earlier, that are, private equity strategic acquirers that have an existing holdings or portfolio business, and they're bolting on, a $1 or $2 million earning business onto that, or a family office that has maybe wants to enter the space with a platform. There's also this distinction between bolt-on and platform that you'll hear a lot of, what I'd call institutional. I use the term institutional investors to encompass like private equity and family office. But if it's kind of more than $3 million in earnings, so $3 to $5 million in earnings, a lot of businesses view that as a platform. Like that business can stand on its own. and be
Gotcha.
part of our portfolio. If it's under $3 million in earnings, they're probably going to look for another business and they're going to bolt that on. You know, you have maybe an existing platform that's generating $3 million of earnings, and we're going to go out and buy businesses making $1 million, $2 million, $3 million, and we're going to add those in where they make sense. And we're going to try to come up with a business that's, you know, consolidated, has $10 million in earnings, and then they'll probably resell that.
And then they'll sell it. Perfect. So that's basically the M&A game in a nutshell at that level.
Because what you get is it's called multiple expansion. So as the businesses get bigger, the multiples that buyers pay get larger. And so, you know, the classic private equity investment strategy is you buy business that you pay 3 or 4 times, you put a couple of these businesses together, you have to execute on that consolidation of the operations, and then you end up with a business that is worth 6 or 7 times its earnings. So you create value through combining the cash flows of these businesses. And then if you can then additionally organically grow the businesses, that's when you can get into these really, really significant returns.
Yeah, really big. So, and that's why you were saying to me earlier, you're seeing that inflection point at around 2 mil. Is that you said that's where things start?
2 million is an inflection point for a couple of reasons. One is that you bring in institutional investors who are looking for these bolt-on, and some even in the 2 million space will have a platform company that can stand on its own with 2 million earnings. And then you also have access to non-SBA capital. So banks, commercial banks, will lend on, you know, what we call EV reliant or collateral light loans for companies generating more than 2 million in earnings. And so,
let's clarify, Isaac, if you're listening to this, when Isaac and I are talking 2 million, we're talking profit, so EBIT, not sales. This is actual profit. These are getting
2 million in profit. That's right. And most of these digitally native businesses don't have a lot of tangible assets like a brick and mortar company might have, right? They don't have forklifts, and they often don't own real estate. They don't have a fleet of trucks driving around, or, you know, their biggest asset is typically going to be inventory and receivables. And then they've got intangible assets of the value of the brand, trademarks, and any intellectual property. But because there's not what banks like to think of as collateral is, you know, tangible physical assets located in a building somewhere, these digitally native businesses don't have it. And so the banks want to see bigger businesses earning over $2 million before they're going to be comfortable lending. Because when a business has a couple $1 million of cash flow, it's more secure. It's a more stable business that a bank can lend against, actually monetize the value of that cash flow and lend against that. And so they're relying on the value of the business as their collateral rather than the assets of the business.
So for someone listening to that, Isaac, this should be opening your eyes, if you're listening to this, that there's a whole game here that you can play. If you've got the big goal, so there's these different levels. So there's the level where you start out and you learn this stuff. Then there's the next level where you might get into a 7-figure online business like your client did, Isaac, that, you know, she bought the 4 million business with 400,000 down. But then you can start to be thinking about the next level, getting to that profit of 2 million above. Like Isaac said, there's an inflection point there. That's when things start to get really interesting. And at that level, really, someone should be talking to, say, yourself, Isaac. Might as well give you a plug. They should definitely be talking to someone like yourself or anyone at Website Closers. But also, that at that level, that's in the private equity sphere. So typically someone then is raising funds and doing this at a big level.
That's right. Yeah. And within private equity, there are private equity groups that are funded, that have committed capital behind them. There are sponsor deals where you've got investors who maybe are going to take some operational role in the business, but they're going to go out and try to raise capital after they get a deal under contract. And then there are family offices that are owned by wealthy families who have a bunch of capital, and they actually form a business entity to go out and invest their own capital and make a return on it with the acquisition of operating businesses.
Awesome. So bottom line is, once your business becomes highly profitable, you've got a lot of options at every single level there when you think about it too. And it's really interesting. I couldn't help but think, now coming back to the beginning of our interview, this digital agency space, now it makes sense why they're so attractive, because they are very profitable, really. They're asset light, they're quite nimble. That, and the recurring income. So I'm guessing the private equity firms, does that make it a lot easier for the private equity firms in terms of borrowings as well? Having that recurring
absolutely,
income?
Yeah. The recurring revenue component gets lenders much more interested in the business, because it again, what a lender is going to look for is directly related to what drives valuation, and that's stability of cash flow over time.
Stability,
yep. Yeah. So the more stable the cash flow is, the more somebody's going to be willing to give you a loan against it, and the more somebody's going to be willing to pay against it. And I think the extreme example of that is SaaS businesses. We also sell software businesses. And so, software, where a digital agency in this space of $2 to $5 million of EBIT might be in, kind of the 4.7 to 6x multiple range.
Okay.
SaaS businesses are often going to be, you're going to hear talk even in the same size, relatively small businesses are going to be 6 to 10x, because what software has is it's got an upfront development cost and then just a cash flow cow after that. You've got people paying your $19, $29, $39 a month. And if you can sell those services, every incremental sale costs you nothing at that point. So you've got to still maintain the business and keep the software up to date. But SaaS businesses end up getting a higher multiple because of the cash flow generation potential that they have. Digital service businesses are I would say, kind of the next step down from that, of really strong multiples, but you still need a team that's constantly producing, whether it is, if you're doing performance marketing or social media marketing or SEO or backlinks, you still need a team who's out doing those things every day to perform for your clients. But those clients will continue to pay you monthly for those services.
That's awesome. So digital agencies are still on pretty high multiples. What did you say? 4.7 to what? To
4.7 to 6x is what we've been seeing over the last 12 months for these agencies that are, making a couple $1 million of profit.
Wow, that's pretty cool. So, although nothing ever beats SaaS, does it? But like 10x
nothing
on
beats SaaS.
SaaS.
But there are a lot. My business partner and I were just presenting at an SEO conference 2 weeks ago called OMG Live down in Cocoa Beach. But there are just hundreds and hundreds of these SEO agencies out there that are kind of in this space, and it was surprising. It's always just surprising to me how many people don't know how much their businesses are worth.
Yeah, so
how much they're worth, and then really, like, what do you need to do 6 months, 12 months, 24 months before you want to sell? What are the things that you can be doing right now that are going to add value to your business, even if you're not planning on selling it anytime soon? If an exit is at all in your future, we love to talk to businesses early and advise them on how to set up their structure, how to set up their team, how to set up their contracts. For one thing that I see that's a really low hanging fruit is, are your contracts assignable, so that when you sell them, the buyer doesn't have to go and renew all the contracts with every client you've got. That's something you could put assignable. What are the term of the contracts? You can have a 30-day cancellation period, but if you've got a 6-month contract, it's viewed as more valuable than just having a 30-day renewable contract, or not having a contract in place at all, which a lot of companies operate without contracts. But I always say, just give your client a short cancellation term and have a contract in place, because it will add value to a buyer.
And Isaac, I want to reiterate that for someone listening here. Did you hear what Isaac's main bit of advice is? People don't realize how valuable the assets they're sitting on with their digital businesses, whether it's a digital agency or a content site, SaaS site, e-com site. People, you're in the trenches working away at it. So I guess, Isaac, you're one of the things that you guys can specialize in, where you can help people, is A, get a valuation, but also B, start thinking about the exit a year or two in advance. Are you happy to chat to people even like a year or two in advance?
Oh, absolutely. Yeah. And in this space, I think, if you own a company that's worth $10 million, you need to be thinking about 12, 18 months ahead of time. what to do to sell it. And look, people come to us and they're ready to sell for a variety of reasons. Maybe they've had a partner that exited, and we're happy to take a company to market wherever it's at, right? We'll do that. But if given the coefficient of some extra time, there are things we can do that it can add significantly to the valuation. We can make an exit roadmap. We can form a full exit plan and show kind of on a quarterly rolling basis how that valuation will change if you execute on some of the steps that we'll advise you to take. So yeah, we're always happy to have those conversations and talk with people up front. And, in fact, that's how almost 100% of my business comes from referrals. So, when I work with people and kind of advise them, once they start to see that value, that's how I get other referrals. So having those conversations is what we do every day.
That is awesome, Isaac. So guys, if you're listening to this podcast and you're in that position where you've got a mil EBIT plus online business, make sure you reach out to Isaac Porter from Website Closers, and we'll put your contact details at the bottom of the podcast as well, Isaac. And I want to say a big thank you for coming along as a guest on today's Digital Investor podcast. That was awesome.
Yeah, man. Anytime. I love, talking deals is like what I love to do. So anytime, happy to do it. And yeah, it's been fun.